Today we'll be dissecting the S&P 500 only, but still look at it from 5 different angles, starting with two-way volatility, patterns, short-term work, the trend, and then take some time to really break down the reversal that we saw this past Friday, which continued with the big advance on Monday, November 10th. So let's look at two-way volatility. As everyone knows by now, I like to look at the number of 1% moves per month, just tracking them on a rolling basis to get an idea of how intense volatility is. As we talked about many times before, the VIX is one way to measure it, but what that doesn't capture is when you have very big moves to the upside. And so in looking at this, of course, we know that things were excessive back in March and April, but since that point, volatility really has been non-existent. But that's changed over the last 4 weeks. And you really can't see it here specifically, right? Because we had 5 in October and 3 so far in November. So nothing really sticks out like they did in March and April when we had 12 each. And if you compare this to what took place in both 2023 and 24, when we had obviously very good years, just having say 5 or 6 at a clip was relatively high. But for those years, most of those months, as we know, had 5 or below. And even though we rely on these tables to keep us on the right side of the trend, sometimes we have to take a closer look. And doing that, we know that since October 10th, just basically 4 weeks worth, there have been 8 1% moves in a 4-week period. So if this was a calendar month, we'd see 8, and that would pop up as being the most again since April and make us think that, well, maybe the market isn't as consistent or non-volatile as it has been. Really, that has been the case. Go back to, again, this all started on October 10th when we had that huge decline, 2.7%. But that was immediately followed by a strong response. Or over the next 2 weeks or so, had 3 1% advances intertwined with these smaller moves. And, we saw some good breadth along the way. Well, since that point, right, as October ended and November began, a lot more downside, right? So 3 1% declines here in 6 trading days, right? That's a pretty big cluster, especially compared to what we've seen over the last few months, which was nothing like this at all. Up to this point, there were only 4 1% declines really since the beginning or the middle of April. And so a much big difference. And most recently, as we know, finally got that face-ripping rally, which we know started on the 7th and continued to the 10th, which we'll review more as well. And so we just need to consider what this means. And we can tell how different it appears just by, again, looking at the chart from all of the 1% moves that have taken place since that key high or low here on April 21st, right? And there was, some big gaps along the way without 1% decline at all, even in 1% gains, right? This point, especially in between some late August to the mid-October. So again, things really changed at this point. And so as we can tell, even though the market has made new highs, it hasn't been as smooth sailing as it has before. And when we have heightened two-way volatility, it just means that what? The pattern work isn't going to be as clean as it was either. And so we started to talk about this a little bit when the S&P 500 hit its last big upside target. Remember, this was the 4th big objective that we've had derived from the pattern work that we do. And that was a target of 67.45 that was hit right at the end of September, early October here when it crossed 67.50. And at that point, we had no more bullish patterns left, especially the larger versions. And we said at the time, it was like a jump ball from a pattern perspective, meaning that we exceeded all of these targets. And what needed to happen there to get more of them was what? More two-way volatility or bigger drawdowns we've seen, because when we see pullbacks emerge, that eventually can then turn into those biggest formations. But at the same time, after being up so much, say 30, 40% at that time with no bearish patterns working, it was a chance for some of them to actually pop up, see some more bearish setups take place with the bears to take advantage of. We know easier said than done, but even though the market was able to respond well, right after that is when things turned. We just talked about, we've had 8 1% moves since that point. So it's not a coincidence by any means. And so there's been some fake outs to the downside, fake outs to the upside. And now the market is obviously trying to reestablish this trend along the way. And so it started with seeing a cup and handle pattern negated. We had talked about how the big pullback from that day could eventually lead to a cup and handle pattern or something like it. And that's exactly what happened. And with the S&P responding well during that Fed week and some key earnings coming out, we had a very strong extension, as we know, over those few days, but couldn't quite get to 69.50. And the ensuing pullbacks, which again had those 1% declines within there, took it back below the 67.50 breakout zone. So we finally had a bullish pattern negated, right? It's had 5 in a row that worked, if not including the tiny ones in there. And so this doesn't really change the overall trend, but it does tell us that there is a character change, that we haven't had the immediate upside follow through to attain a target and have another bullish pattern form like we saw over and over again over the last few months. So that gave, of course, the bears a chance to capitalize on the slowing momentum. And the bears, in fact, did take advantage this time. As we saw from November 6th here, we had that big downturn, another 1% decline, finally gave us a live bearish pattern for the first time since April, right? And remember, on the way down, there were a handful of ones that worked, 3 straight, as a matter of fact, from February down to April. And remember, at that last April low, we had said the same thing. This is a jump ball. The bulls can take charge at some point after all these other bearish pattern targets have been attained. So the same thing now for the bears. And we know that lasted about a few hours with, again, the big reversal here on Friday, and then the strong extension since that point. It's back to square one for really both sides at this point. And so, it's nothing new to see a bearish pattern fail. It was different, again, seeing pretty emphatic break of that support zone, but, we saw something similar, right, at the end of May. The initial breakdown looked like a small inverted cup and handle pattern, just like this one. Didn't work out, and then another chance here, so forth and so on. None of them have worked. And it just tells us that the uptrend remains in play. When bearish patterns fail, we know that it is a clear indication of buyers still ready to step up and buy the dip, which they did once more. And so now we can look at the potential for others to form, right? Even though we've had a strong move from these last few days of bouncing, anything that fails to get it back above the last high could in fact be a lower high, right? And the lower high is what you need to have a bearish pattern form. Again, we just continue to track these because we get very good information, whether they work out or not. Not saying we're going to wait for this to occur, because we know we're in the spot where the S&P just showed that it can rally. We're in the middle of the fourth quarter, and you don't have to go through all of these studies, but strength begets strength. It's back to square one, and we try to look at these, in isolation every time they pop up. Now, on the bullish side, same thing, right? Any one of these big turns from a key low, we've seen them over and over again, can eventually turn into a bullish pattern. And this is the biggest pullback that we've seen, which we'll take a look at in a second, going all the way back to April. So that means if we eventually get back to those new highs, what does it give us? It's going to give us the highest target that we've seen since that point. It's going to be a good deal above 7,000. So a few steps ahead. And as we know, these tend to morph into other things along the way. So next, we're going to focus on the short term. But before that, again, if you like this kind of content, there's a whole lot more at CappThesis.com. You can check out all the free information we have via Substack here, and also the premium services. It gives you an idea of exactly what our clients get as premium CappThesis clients. You can read all about how they feel about the service as well, some of them being with us now for over 3 years since we started. You can also get to see some free samples and a few other helpful tabs as well. So again, CappThesis.com. I look forward to seeing you there. So let's get at the short term. And the short term has been extremely important and helpful, especially over the last few weeks when the patterns, again, have given us some false readings along the way. So initially, during this big pullback, the biggest down move up to this point was down 3.6% from the July high to the August low, and it returned right away. So this one was bigger, right? It came after a really strong move to the highs, 4.2%, and then turned on a dime. Now, we didn't know that was going to happen, but what we were looking for along the way, how far did this RSI could get back down? Because even though things have been very consistent since late July, August, as we can tell, the downturns have been strong enough to produce oversold readings each and every time. That happened 5 straight times heading into this last downturn, this being the 6th one. And once more, that was enough to encourage buyers. Again, it shows the behavior of the market. And that behavior, whether they're in the form of classical patterns or ebb and flow action like we've seen recently, we have to respect it. And we're going to respect this, again, until we see a market change. So on the way up now, what has been happening every time? The S&P has made new highs, right? Higher highs. And most of those times, it's been strong enough to produce overbought readings. So if one of those things doesn't happen this time, it could tell us again, looking for any signs, even in the very, very smallest level of a potential character change. But right now, given what's happened, we should expect the same to occur. And if it doesn't, we'll take notice of that. So on the reverse, this is what it looks like, right? Now we're up about 3.1% from Friday's low. And as we can tell here, looking back at the same time frame we just viewed from the drawdown perspective, it's not quite back to the average, but getting close. We've seen a number of them where it's been above 4% and 5%. So not too surprising to see this extend more. And again, if it does just say, 2% or so, it's going to get us to new all-time highs once more. It's going to pull that RSI back into the 70 zone, and then we'll see how it goes from there. Maybe time for a break once more. We know how that has played out. And so from a trend perspective, we look at this from the go, no go lens. Again, very helpful. Number one, knowing that from right here, right in the middle of May, this is when the trend went to go or turned to bullish. And that has not been altered at all, which is important because when everything else was kind of rolling over, when we saw the bullish pattern get negated, and when there was some pretty heavy selling, and of course, rhetoric has always been negative. We saw 6 straight green bars, meaning that there's been a weakening bullish trend. And that can eventually lead to, right, a rollover or a change of trend or some sort of inflection point that could lead to the no-go signal, which again, we haven't seen since coming back from this. But that never happened, right? And again, we don't know what's underneath this trend that the good people go, no-go use, but it was correct in telling us to stay in the trend even as things became more of a sell-off than we've seen over the last few months. And that's very important, again, because even though we just mentioned how the pattern work has been much more erratic and giving us some false readings, this trend has remained in place. And this is something we'll continue to rely upon and obviously look for clues if and when things start to roll over once more. And from a weekly perspective, we're now on 20 straight weeks of being in a bullish trend. Talked about it as it flipped way back here, right before the market made a new high, that we saw the same type of thing occur. And we saw months and months of strong action after that occurred. And so far, this has played out exactly that, like those past instances have as well. And along the way, it wasn't always easy, quote unquote, it never is. But from that 2023 low, we had a few potential counter trend signals on the weekly chart. None of them mattered until, again, February. And we had 2 in a row right here over the last few weeks. And of course, those haven't mattered yet too. And so this still remains solidly bullish with all the bars being blue so far, meaning, strong bullish trend. Okay, and lastly, all of this really started, from the reversal that we saw on Friday. If you looked on X at all, you probably heard the term hammer a number of times. And it was right to use that because exactly what happened, where it just means that you had a big reversal with the S&P or whatever security you're looking at closing near the high. That's all it already means. And you think back to that short-term chart we just talked about, right? All of these times, for the most part, all these hammers that occurred in the past occurred after getting to short-term oversold levels, right? After the market had pulled back, say, between 2, 3, and 4%, and created that depressed state enough to encourage dip buyers to, in fact, buy the dip, which we know is true now. And in terms of the hammer, and with really all candlesticks, there's always two parts to it. You can have the signal, you need confirmation. The confirmation came in emphatic fashion, right, with the gap up on Monday and the extension from that point. And our friend Ryan Dietrich at Carson Group, of course, pumps out all free, helpful information all day long. Looked at this and said, well, there's a number of things going out, right? Friday's shakeout at the 50-day moving average could be a bullish event, and why, right? The S&P was down over 1% at the time, then closed higher, showed that the very strong reversal. It was also breaking below 50-day moving average and closed above it. So you put all those things together, told them it was a great parlay, and you get some pretty bullish action going back to 1980. You can see all the spots here that it occurred at. He has plotted on the long-term chart. And if we zoom in to here, you see specifically what this has done over the next number of months up to the 12 months. And specifically, this is where it really matters. 6 months later, 12 months later, up over 80% of the time, both times with an average return of 9% and 16%. So we've seen some big moves already. And again, it just tells us that strength does beget strength. These are just numbers, but when they line up with the trends, with pattern work, then we can get a higher conviction level that something like this could take place over the next year as well. That's it for today. And don't forget to check out these other 5 chart videos right here.